Imagine filing an insurance claim and receiving payment in under 3 seconds. No paperwork, no agents, and no back and forth emails. That's not the future of insurance. That's Lemonade. Today we're going to be discussing Lemonade, a company that is fundamentally rethinking how insurance operates and why we believe it represents a compelling long-term investment opportunity. Let's dig in.
Lemonade is not a traditional insurance company. It is a technology company operating in insurance. Founded in 2015 and headquartered in New York, Lemonade built a fully digital platform that replaces brokers and bureaucracy with AI-driven automation. The company currently serves over 3 million customers and offers renters, homeowners, car, pet, and life insurances, all integrated into one digital ecosystem.
We are recommending Lemonade Inc. as a buy with a $112 target price, representing a 70.4% upside from the current share price.
If you look at the 5-year stock chart, we see significant volatility, including periods where Lemonade traded above $100 per share during earlier high-growth phases. That volatility tells us two things. First, the stock moves heavily based on growth expectations. Second, the market has previously assigned premium valuations when momentum accelerates. Our thesis is that improving fundamentals can support a re-rating over time. Lemonade's core revenue drivers in first premium or IFP, the annualized value of active policies. Over the past year, IFP increased from $888 million to $1.158 billion, 30% year-over-year growth. Customer count grew 24% and premium per customer increased as well. This dual trend shows Lemonade is not just adding users, it's generating more revenue per household. At the same time, underwriting is improving. The trailing 12-month gross loss ratio declined from 88 to 67%. That means Lemonade is paying out less in claims relative to premiums collected.
Lemonade started with renter insurance, low premium entry-level policies. Now customers can be cross-sold into homeowners, pet, and car insurance, which carry higher premiums. This increased revenue per customer and improves long-term durability. Cross-selling also lowers customer acquisition costs while increasing lifetime value. And finally, geographic expansion, where Lemonade is continuously expanding internationally and to more U.S. states. The U.S. insurance market is over $1 trillion and dominated by legacy players like State Farm, Progressive, Berkshire Hathaway, and Allstate. Lemonade's overall market share is still small compared to those incumbents. However, when digital insurance and younger demographics, Lemonade is growing much faster. It sits at the intersection of insurance and artificial intelligence, and as financial services digitize, that positioning becomes increasingly valuable.
The competitors for Lemonade mainly consist of the previously mentioned leaders in legacy insurers and additionally rising insurtech companies, including Rue, Hippo, and Next Insurance. While Lemonade's overall market share remains small relative to the major legacy carriers, it is competing to a faster-growing digital segments. Lemonade's overall U.S. market share is still modest compared to these legacy carriers. However, within digital-first insurance and younger demographic segments, particularly renters and pet insurance, Lemonade's technology-driven model allows faster customer acquisition and scaling. Its positioning is differentiated by AI underwriting, fully digital claim processing, and no agent-based distribution.
Our investment thesis relies on 4 pillars. First, Lemonade operates a fully digital, AI-driven platform structurally positioned to modernize insurance. Second, the company is demonstrating strong premium and customer growth, 30% IFP growth alongside rising premium per customer. Third, product expansion into car and pet supports cross-selling and high revenue per household. Fourth, operating leverage is beginning to emerge in Q3 2025. Gross profit rose 113% year-over-year and gross margin expanded to 41%, reflecting improving efficiency as fixed technology costs are spread over a larger premium base. This is a growth company beginning to show margin traction. We view Lemonade's moat as narrow but emerging. Its data advantage improves as more policies are written and claims are processed. The more data collected, the more refined underwriting becomes. However, barriers to entry in insurance are not insurmountable, and large incumbents possess scale advantages. So while differentiation exists, it is still evolving.
Using Porter's 5 forces, we rated Lemonade's competitive rivalry as high. The industry is highly competitive. Legacy insurers compete aggressively on pricing and scale. Lemonade competes through technology and efficiency rather than size. The threat of new entrants is moderate. Insurance is regulated and capital intensive, creating barriers to entry. However, digital platforms reduce distribution costs, allowing insurtech startups to emerge. Our bargaining power of suppliers is moderate, as Lemonade relies on reinsurance partners to manage risks, changing changes in reinsurance pricing could impact margins. Our bargaining power of consumers is high as consumers can easily compare insurance quotes online, increasing price sensitivity and switching risk. And finally, a threat of substitutes is low. There are no direct substitutes to insurance. It is legally required in many cases, which supports long-term demand stability. Overall, while rivalry is intense, Lemonade differentiates through technology and cost structure rather than scale. Financially, the most important trend is this. Premium growth is accelerating while loss ratios are improving. In-force premiums increased 30% year over year. At the same time, the trailing 12-month gross loss ratio improved from 88 to 67%. That means Lemonade is growing faster while paying out less in claims relative to premiums collected. This dual trend indicates improving unit economics beneath reported earnings, and although net income and free cash flow remain negative, margin improvement suggests movement towards long-term profitability.
Now let's walk through our valuation scenarios. In our bear case, revenue growth slows meaningfully, below 15%, and underwriting improvements stall. If the car segment struggles or claims severely rises, loss ratios could move in the wrong direction. Because of this, investors would likely reassess growth expectations and value Lemonade more like a traditional insurance rather than a high-growth platform, pushing the stock into the $45 to $55 range. In our base case, which supports our 112 price target, we assume Lemonade sustains revenue growth in the 20 to 25% range over the next several years. That growth is driven by continued expansion in-force premium, customer growth, and scaling higher premium products like car and pet. At the same time, we expect underwriting to continue improving. We've already seen the gross loss ratio decline from 88 to 67%, and we believe gradual margin normalization is achievable as pricing modules mature. Under those assumptions, a 112 share price is reasonable and defendable. In our bull case, we assume revenue growth remains above 25% for a sustained period of time. Lemonade car sales efficiency underwriting continues improving toward industry averages, and margin expand faster than expected. As the company approaches profitability and demonstrates consistent execution, the market could reward it with premium valuation and multiply similar to those seen during prior high-growth phases. In that scenario, the stock could trade in the 140 to 150 range or higher.
This scenario framework shows that while risk exists, the upside is driven by continued execution premium growth and underwriting efficiency, both of which are already trending positively. Additionally, we performed a 7-year discounted cash flow analysis using a 26% 5-year growth rate, a 3% terminal growth rate, and an 11% discounted rate. However, it's important to recognize something. Traditional DCF models are structurally conservative when applied to early-stage high-growth companies. Lemonade remains in an active scaling phase. It is prioritizing customer acquisition, product expansion, and data accumulation over short-term profitability. Because of that, current net income and free cash flow remain negative, and that mechanically suppresses instinct value in a conventional DCF framework. But Lemonade's long-term value is more closely tied to premium growth trajectory, underwriting efficiency, and operating leverage, not near-form earnings. We therefore view the DCF output as a conservative floor evaluation rather than a ceiling. Of course, there are investment risks. Lemonade remains unprofitable and must execute carefully in newer segments like car insurance. The company faces competitive pressure from well-capitalized legacy insurers, and because the stock trades on forward expectations, any meaningful slowdown in premium growth or underwriting improvement could pressure valuation. That said, the data shows strengthening fundamentals. Premium growth is accelerating, loss ratios are improving, product mix is shifting towards a higher value segment, and operating leverage is beginning to emerge. Lemonade operates as a high-growth, digitally native insurer focused on scaling its platform and accumulating underwriting data, not as a mature legacy carrier optimizing for short-term earnings. And as the company transitions from a growth towards profitability, we believe the market will increasingly reward that structural positioning.
Furthermore, there are ESG considerations. Environmentally, Lemonade operates as a fully digital insurer, reducing paperwork, physical infrastructure, and resource usage compared to traditional careers. Additionally, Lemonade initiatives such as tree planting and carbon impact programs.
Socially, Lemonade emphasizes transparency by taking a flat fee from premiums and donating leftover funds through its give-back program to customer-selected causes. This structure reduces conflicts of interest and builds trust. From a government standpoint, as a publicly listed company, Lemonade maintains strong disclosure standards, including shareholder letters, quarterly filings, and independent board oversight.
Overall, Lemonade's ESG profile aligns with its mission to modernize insurance through transparency, efficiency, and technology-driven accountability.
For these reasons, we recommend buy with a 100 512 target price. Thank you.